VIP John A.G. here. The state of Wyoming just passed legislation to allocate state funds into physical gold and silver. Let me say that again. A sovereign state inside the United States of America looked at the financial landscape, looked at the trajectory of the dollar, looked at what central banks around the world are doing, and decided to start stockpiling precious metals with taxpayer money. And they are not alone. China's central bank has been buying gold for over 18 consecutive months. Central banks globally purchased over 1,136 metric tons of gold last year alone, the second highest annual total in recorded history. Meanwhile, silver is sitting at roughly $32.50 on the COMEX, while in Shanghai it is trading at a persistent premium north of 4 to 8%, depending on the contract. Gold is hovering around $3,230 per ounce. And here is what nobody on mainstream financial television is willing to say out loud. Governments know exactly where silver and gold are headed. They are accumulating right now, quietly, deliberately, and in size, while the paper market keeps the price suppressed just long enough for them to finish loading the truck. This is not speculation. This is documented, verifiable, and happening in real time. And by the end of this video, you are going to see exactly why the target that sounds insane today, $500 silver, is not only possible but mathematically inevitable when you follow the money trail that governments themselves are leaving behind. Let me walk you through the data because this story has layers that most analysts are either too lazy or too conflicted to connect. Start with Wyoming. House Bill 206 was signed into law, authorizing the state treasurer to invest a portion of state funds in physical gold and silver bullion. This is not a symbolic resolution. This is not a suggestion. This is legislation that gives the state the legal authority to hold precious metals as a reserve asset. Think about what that means. A government entity inside the United States is telling you, through its actions, that it does not fully trust the instruments denominated in U.S. dollars to preserve the purchasing power of its reserves. Wyoming joins a growing list of states including Texas, which has its own physical gold depository, and Utah, which recognized gold and silver as legal tender. These are not fringe actors. These are state governments making strategic financial decisions based on the same macro data that you and I look at every single day on this channel. Now zoom out to the global stage. The People's Bank of China has been the most aggressive gold buyer in the world. Official reserves have climbed to over 2,300 tons. But here is the part CNBC will never tell you. Multiple credible analysts, including those at the World Gold Council and independent researchers tracking Shanghai Gold Exchange withdrawals, estimate that China's true gold holdings are significantly higher than what they officially report. Some estimates put the real number north of 5,000 tons. China does not update its reserves in real time. They announce in bulk, strategically, when it benefits their geopolitical positioning. And while the mainstream focuses on gold, pay very close attention to what is happening with silver in Shanghai. The Shanghai Futures Exchange silver contract has been consistently trading at a premium to the COMEX price. Right now, that premium sits in the range of 4 to 8%. That means buyers in the world's largest manufacturing economy are willing to pay significantly more for silver than what the Western paper market says it is worth. That is not a rounding error. That is an arbitrage signal screaming that the COMEX price does not reflect reality. Let me give you more numbers, because numbers do not lie. COMEX registered silver inventory, the silver actually available for delivery against futures contracts, has been declining steadily. We are looking at roughly 135 to 140 million ounces in registered category. Sounds like a lot until you realize that global industrial demand for silver is running at over 650 million ounces per year and climbing. Solar panel manufacturing alone consumed over 200 million ounces last year. Electric vehicle production, artificial intelligence data centers requiring massive silver paste for semiconductor connections, fifth-generation wireless infrastructure, defense applications, medical devices. Every single growth sector of the modern economy requires silver, and not a single one of them has a viable substitute at scale. The Silver Institute's latest data confirmed that the silver market has been in a structural supply deficit for 3 consecutive years. total supply from mining and recycling is not keeping pace with total demand from industrial fabrication, investment, jewelry, and silverware combined. The deficit last year was estimated at over 140 million ounces. Let me say that again. The world consumed 140 million more ounces of silver than it produced, and prices barely moved. If that does not make you question the integrity of the price discovery mechanism, nothing will. Now let me connect another dot. Central banks globally are buying gold at a pace we have not seen in decades. The World Gold Council reported that central bank net purchases exceeded 1,000 tons for the third year in a row. Countries like Poland, India, Turkey, Czech Republic, Singapore, and several unnamed central banks through the Bank for International Settlements have been aggressive buyers. Poland alone added over 130 tons to its reserves recently and publicly stated its goal to have gold represent 20% of total reserves. India has been quietly repatriating gold from the Bank of England and adding to domestic holdings. These are not speculative hedge funds. These are sovereign institutions with teams of PhD economists who have access to data we will never see. And they are all doing the same thing, converting paper reserves into hard assets. Ask yourself a very simple question. If gold and silver were just barbarous relics with no monetary future, why are the most sophisticated financial institutions on the planet buying them at record pace, while simultaneously telling the public that everything is fine? Looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered, data-driven analysis is helping you cut through the noise and see what is really happening in these markets, hit that subscribe button. That is how we build a community grounded in truth, not hype. Drop VIP John AG in the comments so I know you are part of Team VIP. I do not sell signals, mentorships, or courses. I never will. This channel exists for one reason, to give you the information the mainstream will not. If that is not for you, no hard feelings. I do not chase empty metrics. But if you are an OG who values clarity over clickbait, you know what to do. Now here is where it gets truly insane, and this is the part they absolutely do not want you to see. Let me lay out the smoking gun. The gold to silver ratio right now is sitting at approximately 99-1. That means it takes roughly 99 ounces of silver to buy 1 ounce of gold. The historical average over the last century is around 60-1. The geological ratio, meaning the ratio at which these metals exist in the Earth's crust, is approximately 8-1. Silver comes out of the ground at a ratio of 8-1 relative to gold, yet the market prices it at 99-1. Even if you completely ignore the geological argument and just normalize to the 100-year average of 60-1, with gold at $3,230, silver should be trading at approximately $54 per ounce. That is a 65% premium to where it sits today. But here is where the $500 number starts making mathematical sense. If central banks continue buying gold at the current pace, and every indication suggests they will accelerate, gold is headed toward $5,000 per ounce at a minimum within the next several years. Many credible analysts, including those at major banks like Goldman Sachs and UBS, have already revised their gold forecasts above $3,500 and in some cases above $4,000. If gold reaches $5,000 and the gold to silver ratio simply normalizes to its historical average of 60-1, silver goes to $83. If the ratio compresses to 40-1, which it hit during the last major precious metals bull market, silver goes to $125. And if we see the kind of monetary crisis that multiple governments appear to be preparing for, the kind of crisis where gold goes to $10,000 as some sovereign wealth fund managers have privately modeled, and the ratio compresses to 20-1, which it reached in 1980, silver goes to $500 per ounce. This is not fantasy. This is arithmetic applied to historical precedent during monetary resets. And the behavior of governments right now, from Wyoming to Beijing, tells you they are positioning for exactly this scenario. Here is another layer. J.P. Morgan Chase, the largest bullion bank in the world, the bank that has been fined repeatedly for manipulating precious metals markets, currently holds one of the largest physical silver positions in history through its vaults and custodial accounts. As I said in a previous video, when the institution that has been caught suppressing the price is simultaneously accumulating the physical metal, You do not need a conspiracy theory. You need common sense. They suppress the paper price to buy the physical cheap, and when they have enough, they let the price rip. This is the same playbook they have used for over a decade, and the public data from COMEX Vault reports confirms the accumulation pattern. Now let me give you the physical versus paper reality check, because this contrast is the single most important thing to understand in the silver market today. On the paper side, the COMEX can create virtually unlimited silver contracts. Each contract represents 5,000 ounces of silver, and the vast majority of these contracts are settled in cash, not metal. Open interest on COMEX silver futures frequently represents hundreds of millions of ounces, far exceeding the actual registered inventory available for delivery. This is how the price is controlled. You can sell what you do not have in unlimited quantities, and because 95% or more of participants never take delivery, the illusion holds. The paper tail wags the physical dog. But on the physical side, reality is diverging from fiction at an accelerating rate. Dealers across the United States are reporting premiums on physical silver products that remain elevated. American Silver Eagles from the U.S. Mint carry premiums of $8 to $12 over spot, depending on the dealer. 1 kilogram silver bars, which used to be commodity priced, now carry meaningful premiums. Delivery times from several major online dealers for certain products stretch into weeks, not days. The Royal Canadian Mint, the Perth Mint, and the U.S. Mint have all experienced production constraints or allocation limits in recent periods. The Shanghai premium I mentioned earlier is the international market's way of screaming that the COMEX price is artificially low. When physical buyers in Asia are consistently paying more than the Western benchmark, it tells you the benchmark is broken. It is not reflecting true supply and demand. It is reflecting the positioning of a handful of bullion banks who have a vested interest in keeping the price contained until they are ready. Let me address the bearish case head on, because balance matters, and I am not here to be a cheerleader. The risks are real and you need to understand them. First, margin hikes. The COMEX and regulators have the ability to raise margin requirements on silver futures at any time. They have done it before, most infamously in 2011 when silver was approaching $50 and they hiked margins 5 times in 9 days, triggering a cascading liquidation. If silver starts moving aggressively toward $50 or $60, expect them to deploy this weapon again. It will cause violent short-term pullbacks that shake out leveraged traders. Second, there is genuine deflationary risk in the global economy. If we enter a severe recession or credit crisis, silver could initially sell off hard as it did briefly during the onset of major economic shocks. Industrial demand could soften temporarily if manufacturing contracts globally. Third, the dollar could strengthen significantly in a flight to safety scenario, putting downward pressure on commodities priced in dollars. And fourth, governments could implement policies that restrict or tax precious metals transactions, making it harder to buy, sell, or hold physical metal. These are real risks. If you are leveraged in silver futures or mining stocks, you could get wiped out on a short-term basis even if the long-term thesis is completely correct. Protect your capital. Position sizing matters. Cash reserves matter. Do not put yourself in a situation where you are right about the direction but wrong about the timing and lose everything. Now let me give you the bullish case because despite those risks, the fundamental picture for silver has never been stronger in modern history. Supply deficits are structural, not cyclical. There are virtually no major new silver mines coming online in the next 3 to 5 years. The permitting and development timeline for a new mine is 7 to 12 years from discovery to production. Existing mines are seeing declining ore grades, meaning they have to move more rock to produce the same amount of silver. Meanwhile, demand is exploding from every direction. Solar photovoltaic installations are growing at over 30% annually worldwide. Each gigawatt of solar capacity requires approximately 1 million ounces of silver. India alone plans to install 500 gigawatts of solar by 2030. China is installing solar at a record pace. The European Union has aggressive renewable targets. Artificial intelligence requires massive data center build-outs, and those servers use silver in thermal paste, connectors, and circuit boards. Electric vehicles use roughly 1 to 2 ounces of silver per vehicle, depending on the platform. Military applications for silver in electronics, communications, and missile systems are expanding. And on the monetary demand side, central banks are telling you with their actions that the current monetary system is approaching a transition point. When Poland says publicly that it wants 20% of reserves in gold, when China buys gold 18 months straight, when an American state passes legislation to hold physical bullion, the smart money is screaming its thesis at you. You just have to listen. 3 key takeaways and we are out. Number 1. Governments from Wyoming to Beijing are actively accumulating precious metals at a pace that contradicts the calm narrative presented by mainstream financial media. These are not irrational actors. These are institutions with access to information and models that the public does not see, and they are all independently reaching the same conclusion. Hard assets over paper promises. Number 2. The silver market is in a documented structural supply deficit for the 3rd consecutive year, while the paper price remains suppressed well below where honest price discovery would place it. The gold-to-silver ratio near 99:1 is a historic anomaly that will correct, and when it does, the move in silver will be violent and fast. Every piece of data, from Shanghai premiums to COMEX inventory drawdowns to dealer delivery delays, confirms that the physical market and the paper market are telling 2 completely different stories. One of them is lying, and I will let you decide which one. Number 3. The $500 silver target is not a fantasy. It is a mathematical outcome of gold reaching levels that multiple central banks and institutional analysts are now projecting, combined with a normalization of the gold-to-silver ratio to levels that have been reached multiple times throughout history during monetary upheavals. The question is not if silver reprices, not if. The question is whether you are positioned before it happens, or whether you are the one buying at $500 wondering why you did not listen when the data was right in front of you. The unresolved tension is this. If governments know what is coming, and their actions clearly suggest they do, how long can the paper suppression mechanism hold before the physical market simply overwhelms it? That is the question that will define the next chapter of this market, and I will be here breaking it down for you every step of the way. Do your own due diligence. Understand the risks. Be accountable for your own decisions. This is not financial advice. This is an analyst sharing publicly available data and connecting dots that the mainstream refuses to connect. Invest with logic, not hype. VIP out.